Hello everyone, and once again welcome back to another video. So as you can see from the title, today I'd like to go through all the trades that I've taken so far in 2020. As you may expect, I'm relatively new to trading and the world of technical analysis and understanding how price action behaves. So naturally, I won't be showing too many trades because of the fact that I'm still very new, and the portfolio I'm trying to build is one that will be built gradually over time, slowly, month by month. Earlier on into my journey, as soon as I started, what really stuck with me was the psychology behind it, the risk management, the money management, and how to protect your capital. So in the past, before I approached this new strategy, as you can see here, provided by Falcon FX, my trading style was much more reckless. I didn't know what I was doing. I didn't know the first thing about risk management. As you can see, capital at risk is always 1%, regardless of how likely I think the position is to play out. And therefore I'm going to be very much more conservative this time around, as I'd like to elevate my trading style and knowledge at this point in time, which I simply couldn't do previously due to a lack of knowledge, simple as that. So what I'd like to first of all introduce is the way that I journal trades. So every time I'm doing some technical analysis, I'm going through a potential setup and whether I can enter short or long into any of these currency pairs. And then once I do that, if I decide to enter an order, I will then record the position starting with the pair, the direction, so short or long, the entry date, exit date. Capital at risk will always be 1% with the strategy I'm using. The stop loss in pips, so percentage in points, I have a whole video dedicated to what this means. The outcome, so loss or wins, and the profit and loss in terms of percentages. The rolling return, and all of these technical terminology that they belong to the strategy, so don't worry too much if you don't know what these refer to. Not every strategy will have this sort of way of referring to different types and grades and other things. Similarly, also this will be whether the trade was a first entry or a scale-in. And then very important is the screenshots for the higher time frame and the lower time frame before the position was entered, as well as after the screenshot after the position closed, and the comments. So I will go through each of the comments to provide you guys with sort of an insight into how I like to journal things, because I believe this is exactly what every sort of traders in the world would need in order to create a portfolio that is consistent over time, and say that they have bigger goals in the future to perhaps bring on investor capital and so forth. They will be able to show this sort of level of journaling, of mindset, of consistency, of discipline, showing that they take this business seriously and they actually treat it as a business as opposed to just a simple hobby. This spreadsheet is very, very high quality and difficult to replicate, so I won't go too much into it, just out of the respect of the people at Falcon who have kindly provided and built this for all of us, the people in the community. But my main focus here would be to go through the trades I've taken and talk a little bit about the psychology around trading as a whole. Okay, so first of all, I opened a live account just around 2 months ago. So since mid-February up until mid-April, so just about now, I've taken a total of 11 trades. As you can see here, the losses were 1, 2, 3, 4, 5. So almost half of the trades I've taken resulted in a loss. 2 were break-evens, meaning I didn't lose money, I didn't make any money either. And then just 4 of them out of 11 were wins. However, just by looking at this, without looking at perhaps the risk management and the percentage for each win or loss, would you then consider this strategy as a winner or a loser? Well, just by looking at the amount of break-evens and losses, you would probably come to the conclusion that this strategy wouldn't work. And, well, out of those 11 trades, I'm still up over 2%, so 2.04%, despite the amount of break-evens and losses. So first lesson here would be that this is a probabilistic mindset that needs to be applied and that every trader needs to have in order to understand that trading is about probabilities. It's a game of probabilities in the long run over a large enough period, over a large enough sample size, over a large enough experience over the years. It doesn't matter whether 2, 3, 4 trades in a row will be losses, as long as you know that the strategy that you've backtested works. And I do know that because of the fact that so many people within the community have reached incredible results, way higher and above what I've reached here, because I'm, again, still relatively new. But as soon as you realize that the concept behind the psychology of trading is essentially, you don't know the sequence of your losers, of your winners, of your break-evens, but you know that over a large enough period of sample size, you will come out on top, then there is no emotions or feelings attached to entering a trade, because you're playing the probabilities. It's like a casino. A casino doesn't know how many people will come in, how many people will win or lose. They know that over a large enough period of years, over a large enough sample size, they will be profitable. And trading is exactly that. In terms of the psychology, I'm not comparing trading to a casino, because that would be pure gambling and would not sort of be do any justice to the study and the research and the amount of hours that needs to be put behind this sort of science in order to become profitable at some point. So first of all, in order to dive straight into it, I've taken my first ever live trade on a live account with real money on GBP AUD, so pound Aussie, so the British pounds against the Australian dollar. It was a short, entered on the 18th of February, as you can see here, and it was a loss. So first of all, as you can imagine, a couple of months of studying, several hours every single day. I was really excited about opening my first ever live account, and then the first trade was a loss. So automatically I'm like, okay, this is is not as easy as people on the social media make it out to be, and it definitely isn't. Obviously a rolling return 1%. The screenshot, this is very important. So what I was looking at is this, and make sure that you journal and keep a log of every single position you take, the before and after. So pound Aussie on the daily chart, so high time frame, was looking at this, waiting for further continuation to the downside, and the lower time frame was looking like that, in the sense that I was waiting for this bear flag to form to then put an entry just below with a stop just above the previous high, tackling this or targeting the first, second, third touch of this outer structure. The after screenshot then was like this. So price tagged me in, so I got entered into position and then went out, and I got tagged out for a 1% loss, as you can see. But the most important thing here would be the comments. So the comments before say that the price broke through the double top and straight after got rejected strongly to the downside. After it then formed a corrective structure, which is where I'm entering to take advantage of the momentum towards the downside. That was before I even knew the outcome. Okay, so you enter this as soon as you've done the before screenshot. Then the comments after say that probably this wasn't the best area to take the trade. In fact, there was a chance that price could have gone higher to top of the structure before committing to the downside. It's okay. So that, as you can see, I'm talking to myself here, saying that it's absolutely fine to take losses, because over a large enough period, large enough sample size, I will come up profitable. But the lesson to be learned here was only enter trades in high value areas. If in doubt, stay out. Okay, so lesson learned, and then moved on to the second trade on euro dollar. Again, a short one, and that ended up being a very slight win. But I was excited because, I was just about to enter into that world of how to manage positions, where to place your stop losses, where to move your, or how and when to move your stop losses to break evens and trail that stop down in order to gain some profit as the position moves in your favor, and so forth. So similar thing here, I was looking at the high time frame structure that looked like this. So descending channel, third touch of the descending channel, anticipating further downside, and this was the 1 hour chart. Now, just by looking at this with a couple more months of experience, I would never take this trade again, and we'll see now why. So the after screenshot ended up being like that. I moved the stop loss at 0.74, price tagged me out, and that was the profit I got left with. Now the screenshot after shows the fact that yes, it was a win, but that doesn't mean that if you win anything at all, you will then be completely oblivious to any lessons that should be learned. Because for every win, break even, and loss, you should always make sure that there's at least one lesson to be learned from it. So it was taken out for a 0.74% after the news about the American interest rate. Okay, that doesn't really matter too much, but it's more giving it a bit of narrative to look back in the future, as I'm doing now. Happy with the outcome as listening to Mark and Neil's opinion on the area. So again, these are the main coaches and people behind the whole Falcon strategy and the community. I realized it wasn't a key area because when we approached the structure, it was very impulsively and not correctly. What I mean by that is the fact that do you see that price action leading up towards that third touch? Yes, we had that third touch. Yes, we had the 1 hour rejection indicating a further move to the downside, which did happen. However, look at the way that price approached that. It's very impulsive. So when something like that takes place, I would stay out, wait for a clear confirmation, flag to enter lower, because that's got a high likelihood of trickling its way higher and higher because of that strong momentum up until that point. Third trade was same pair, again short, and that resulted in a break even. So far into my third trade, I sort of experience all the emotions of a loss, of a break even, and of a very, very small win. Now, when it comes to the screenshot of that, that's what I was looking at. So do you remember the second trade which I said look at? That was the same pair. So we were looking at this area here. Then price ended up pushing even higher, lower, to then retrace 100% of that movement. So all these bearish engulfing candles that sort of ate all the price action that the price gained over the past couple of weeks prior to that, sort of indicated to me and other people within the community that price was then likely to push even lower. And so that's what I did on the first, on the 15-minute chart. On the 15-minute chart, we could see then that was the likelihood of it happening, and the notes that I wrote were this. After strong impulse to the downside, waiting for correction to continue lower, and that's exactly what I did. Waited for price to reach the key area of value I was looking at, enter the trade, placed it down below, so just here, and then so I got tagged in. The position was running quite well, so that would have probably been a 1 to 2% profit, and then completely retraced and luckily got me out for just a break even, because I moved the stop loss to the break even prior to that. Then the lessons for that. After being tagged into the trade, price moved down very impulsively. At this point, the position was running about 1.5% profit, so decided to move the stop loss to break even. However, price then retraced higher and tagged me out. This is the lesson here. When at high value areas, I should be more careful about moving the stop loss to break even straight away, as in doing so I could choke the position and not leave enough breathing room for price action to develop properly. In fact, after being tagged out, price carried on pushing lower. Anyway, I'm happy I could take the lesson from this trade, and we'll move on to the next one without any worries. Do you see sort of like the underlying lesson here is to, whatever happens, try and take a lesson from it, try and learn from it, and then move on. Because there will always be another and another and another opportunity right around the corner. And you've got to be able in that lucid and awakened mindset in order to be not dwelling too much on the past, whatever the outcome of these trades, regardless of them, and then focusing on the next opportunities, because there will always be plenty forever, basically. The next trade was on the Aussie New Zealand, so Aussie Kiwi. That was a win, a 1%, so I was actually excited because it was a first full digit win for me. That was the screenshot. So key value area, very important psychological levels at 1 and 1.02. So I was looking at this double bottom, then formed a triple bottom to then push higher. Key value area, so I was convinced, well not convinced, but I was sort of happy to risk 1% of my capital because of the backtesting and the studying I'd done before, and knew that over a large enough sample size, these will play out. However, price moved lower and ended up tagging me out. Sorry, that's that one trade there, but these two are quite similar, just in slightly different areas. But the lesson that I learned after my 1% loss was this represents a scale-in from the previous trade, which was moved to break even, then locked in 1% profit. So risk was off the table and could expose myself to another 1% of capital. So that's an important lesson that us in the Falcon strategy sort of refer to quite often. Whenever you've got an initial position that runs risk-free, so basically you've moved your stop loss to break even, you can then, if you wish and if you find a good enough setup, enter another position on the same pair but still expose yourself to an overall 1% risk, because again the first trade is now risk-free. So the sixth position I took was on CAD yen on a short position. That was also second loss, so second loss in a row, and that was the screenshot I took. So I was looking at that, descending nature, doji candle almost forming. I was expecting a morning start formation to the upside to tackle that fourth touch of this descending trend line, and that was the lower time frame. So mini double bottom, scoop in nature here, move higher out of that middle section to then target these highs. Let's look at what happened. The after screenshot then formed this sort of picture. So it tagged me out just by a couple of pips, and the spread will always be there. So be mindful of the fact that sometimes the spread will be the reason behind you getting tagged in and out trades. But that's cost of business. Every sort of broker will have any cost with it, whether it's commissions, whether it's swap costs, whether it's spread. So that's absolutely fine. The high time frame shows a clear descending channel, as we saw on the screenshot, with a doji formation at the end of the previous week. I saw this was a potential for moving morning star formation, which would then naturally push to the upside. So I waited for a clear double bottom, as we saw in the screenshot, to form on the 1 hour, saw that price reach the area quite correctively, and therefore placed an order for a risk entry to target the most significant high. The after screenshot, so after the position closed, these were my thoughts. So price kept moving lower. It sort of reacted to the double bottom, but momentum to the downside seemed to be too strong for a reversal. So it ended up taking me out. Maybe the area wasn't of high value. It was just a valid one, and therefore just happened not to play as expected. I'm not too sure. So what I did here, because I couldn't give myself an explanation as to why this didn't play out, I asked people within the community and managed to find sort of like a lesson or a reason behind it. Basically, the area was just valid, but it wasn't high probability. Meaning, do you see here? Yes, there was a double bottom. Yes, there was another mini double bottom between that. However, all of that price action there could have still been filled. So price could have gone lower here to then form a third touch. And I wasn't aware of that because I was very new to the community and still am. That's the thing I would like to convey here, is the fact that these results here can be achieved after just 3 to 4 months of studying, but there is so much more that can be achieved in the future if you're consistent over time throughout the months and years to come, because that's the key, is consistency, making sure that your risk management is always on point, that you journal everything, and that you go into as much of a detailed analysis as possible. Now, dollar yen on the 7th trade, that was also short, and as you can see here, out of the 11 trades, only 2 were longs. That's a very interesting thing, because if you were not to journal your trades, you probably wouldn't realize the amount of short positions against the long positions and vice versa. However, there were a lot of studies in the trading community that sort of showed how naturally, us as humans, we tend to be conservative. We tend to be almost afraid of the future. So we hope that things will always come towards us rather than go away from us. And, it's a very difficult and almost weird thing to talk about, but it is true. Lots of people take many more short positions other than long positions because of that. They're scared of betting for a better future, and they always think that the future will be worse than it already is, and which is why you think the price will go down. This is weird, and I consider myself to be overall a positive and optimistic person in general, but I'm no exception to this sort of rule or this sort of psychological point of view or thing, or whatever you want to call it. So it's interesting to see. Now, the screenshot for that would be, yes, we almost reached that double top area, then pushed lower with these strong momentum candles. I was looking at further continuation here, so horizontal move to push lower towards the double bottom. That's the 1 hour time frame, and I entered it there. I actually quite like this setup, and even after a couple of months of looking back, I'll probably still take the same trade again, because we've got the high time frame structure and alignment, meaning the high time frame is pointed to the downside, we're taking a short. So that's a tick, that's a first confluence factor. Then we've got a reversal channel type formation, meaning it is a pattern that would indicate reversal. And again, that's part of the strategy, and not all strategies will think this way. And then we've got a third confluence factor, which is the double top within the area. So we've got first, second, third touch, rejection. So you could argue there was an entry here. Then went back to form another double top to then push lower, targeting the 90% rule, meaning 90% chance of reaching this bottom here. So I would probably take this exact same trade over and over again, just because of the high quality setup. Now, the after screenshot, in fact, ended up playing out. And like I've said, I'll probably take this 100 times in a row, just because of the high value and the likelihood of it playing out. I like the fact that it really pierced through and then engulfing candle, bearish formation, meaning all the sellers then got all the momentum that the buyers were trying to convey and put into the market, and therefore, you know, a downtrend took place. Now, I trailed my stop loss over there, and that ended up being a nice win for 2.5%. I was quite excited. The management was on point, so I believe I trailed my stop first from here to break even, then on 1%, then on 2%, and then on 2.5. So very good overall. The lesson here would be overall really happy with the position. So happy about the entry, management, and overall 2.5% profit is more than enough. I'm also happy because this meant I could close the month of March with a 2.24% profit, which is always good. Onwards and upwards, starting with Q2 2020. See, that's important to analyze, because regardless of how the position might have gone, I would have still thought about being positive and being optimistic for what Q2 in 2020 and the rest of the year would bring. So then I entered all these positions here, and this is a very sort of nice way of journaling everything. I closed it at 2.24%, but I won't go too much into detail of what all of this means, again, out of respect of the people at Falcon. So now, 8th trade, another short, so links back to the concept I've just talked about always being pessimistic in the future, even if you don't know it on a subconscious level. It happens on a subconscious level. So that ended up being a break-even. Let's take a look at what I was seeing, if that works. Yeah. Okay, perfect. So the impulse to the downside, I was waiting for a clear bear flag for a continuation. Now, looking at this in hindsight, I probably wouldn't take it again. Why? Because of the fact that the impulse started here. Now, we know that the sooner, so the closer from the source or the beginning of the impulse we are, and the higher the likelihood of these flags playing out. Now, if that flag was there, probably 100% I would take it. Okay, but the fact that we are so close from another inflection point, which is here, in hindsight, I probably wouldn't take it again in the future because of that. So the further down we get towards another inflection point, the weaker the position gets, if that makes sense. In fact, that ended up being a break-even. I was sort of like lucky enough that I could move the stop loss to break even. So this sort of tool is just to visually represent the the points of 1, 2, 3, 4% profit. It doesn't mean much more than that. It's just a visual representation. So what happened here? Do you see where price pierced through it? And it probably would have been more visible on the 15-minute chart. Now we're on the 60 minutes, meaning being 1 hour. But on the 15-minute, I was looking at this and saw the price pierced through the 1%. And out of my strategy, I know that I can move the stop loss to break even. Then price tagged me out for a break even, which is absolutely fine. The final lesson would be, this wasn't a high probability one, as the area wasn't at either top, bottom, or structure. So exactly what I just talked about. I will need to filter through the best quality setups to increase probabilities of these positions playing in my favor. So very, very important. It is a game of probability, meaning you are basically playing with statistics. What is the highest likelihood of something playing out over a large enough sample? That's it. That is it. You can have an edge, you can study, you can do back testing, you can do forecasting, but it boils down to this simple rule. Now, pound dollar, the 9th trade. High time frame structure. I'm actually looking now at forming some documents that mainly for myself, for my own curiosity and interest, that I want to see how well this sort of pair or different pairs in the market responds to psychological levels. When I mean psychological, I mean levels that are exactly a finite and simple number, such as 1.32 or 1.165, as opposed to 1.327849. You know, all of these very high decimal numbers. Okay, so that ended up being, as we can see from the screenshot, ended up being a loss. And I was actually entered there due to spread. This was a recent one I took, I think. Yeah, so just about a week ago. I remember this very clearly. We had a good setup, so high value area, and then because of the fact that we were in a bank holiday weekend where both the UK and the United States markets were closed, obviously the spreads were much higher. I remember logging into my brokerage and seeing that it was 14 pips, which is like 10 times as high, higher than normal. But being new and being still at very, very beginner's level, I didn't think about it. But that's where the journaling comes in. So it got me out for a loss, and so I wrote it there. Price moved in the direction I anticipated for a while before reversing quite sharply, thus taking me out for a loss. This is okay, as the lesson I've learned here are as follows. If the high time frame structure is pointing in the right direction, wait, is it? Yeah, okay. I sort of forgot to mention the spread, but that's probably because of the fact that it's not a lesson in itself. It's more something that every trader should be aware of. So I took that I think it was quite late at night. So bearing in mind that when it comes to late at night, so 10, 11, especially towards the weekend, swap hours will be there, meaning this is where the countries will swap the exchanges and they will exchange different currencies, and therefore the spreads will widen. And all of this then leads to a different and poor style management. So I'll probably stay out in the future of this sort of style of trades. Then the 10th trade is on wheat. So my first ever commodity that I traded, and it actually ended up being, ironically speaking, the most profitable one I've ever taken, 2.8%. And the only reason why I've taken it is because it was in a very high value area. So wheat USD has been trading in this ascending channel for a while. Price recently reacted off of a double top and impulsively moved lower, which you can see here, formed a correction, that one there, and therefore looking for continuation to the downside. So visual representation as well as small narrative. Then what happened there? On the 1 hour, I was looking at something along the lines of this. So 1 hour is in line with the high time frame structure. So look at the details. So it's very important to go into as much of a detail as you can, because then you don't have to remember everything you've done once you go back in the future and look at the past, because everything is journaled for you. Formed an ascending channel, which is this one. In the last part, it pulls down, that one there. Formed a correction, so similar to the high time frame, and I've entered on the break of the bear flag with the reduced risk entry. Again, this is a special way of entering a trade that is owing to the strategy, so don't worry too much if you don't know what that refers to. However, there is a possibility that we could push higher once again before committing to the bigger move down. So look at the self-talk there. As soon as I'm entering the trade, I'm almost accepting straight away the potential for a loss. So I'm detaching the emotion as much as I can, which is important. Now, the after screenshot is just as simple as that. So price trickle its way down. I then was lucky enough to be at the screen at that time, so I moved from a stop loss to break even, and then trickled its way down after the inflection point it reached, and then just below it, and then so forth. And the further down we got, and the more aggressive I sort of became when it comes to the stop loss. Probably aggressive isn't the right word, but you know what I mean. I'm just trailing it further down as we go lower, because at one point we were I was on almost 5% profit, and I wasn't ready or wasn't willing to give all the profit back to the market just in case that happened. And in fact, it ended up happening. Took me out for a 2.8% profit, which I was really happy with. Now, overall happy with this position. Could have locked in slightly more profit, but there was and still is plenty of room to the downside, so I wanted to give it enough breathing room. 2.8% is a solid trade and also my best one so far. Very happy indeed. So very important here to be grateful for the opportunity to enter the market in that circumstance and on that day. Last trade that I took yesterday on USD JPY, so dollar yen, ended up being a 1% loss. Never mind. It's absolutely fine because we know, like I've said, that out of 10, 20, 30, a range of 20, 30, 40 trades, you know that the strategy will play out and you'll come out a winner. So looking for further continuation to the downside towards the double bottom as a minimum. So that was the double bottom I was referring to, but we always know that that bigger double bottom is always a potential just a little bit more in the long run. The 1 hour for entry refinement, that's what I was looking at. So Falcon style formation. Again, this is owing to the strategy. 15-minute chart is showing a Falcon flag where price has rejected the double top here. Then impulsively moved lower and formed a clear bear flag, which is exactly that. So I placed my stop there, my enter there with stop just above the high, targeting the outer structure. Then what ended up happening? I got tagged in and then out. Then someone, now I won't read their name, but someone within the community mentioned that this trade was a bit of a risky one just because the flag was a little bit steep, so it wasn't as flat as that one. For example, that one there is a little bit steep, meaning this had the chance of forming a larger one like that before playing out, and that's exactly what ended up happening. So overall, I'm closing this video just by saying that it's very important to have that probabilistic mindset, meaning you don't know the sequence of your winners, of your losers, of your break-even. You know for sure that over a large enough sample, you will come out as winner if you stick to a 1 or 2 or 3%, whatever your strategy entails. But stick to one number always, regardless of how much of a faithful sort of approach you want to have to this position, saying, oh, I risk 5% because I know exactly this will play out because I've back tested it. No, you don't know the outcome, you don't know the future, none of us does. None of us do. So it's important to have that, holistic approach. Look at different factors. Look at, when you journal, look at the pair, if there is any correlation, look at the direction. I've spotted the correlation of being, I take too many short trades as opposed to long. And it's not necessarily a bad thing, but it's more something that comes out as soon as you realize that maybe there's more of a psychological sort of input that should be studied here, and always go down to the root cause of every issue and just try and dig in a bit deeper to understand why that might happen. And if you don't think that's an issue, that's absolutely fine. Then always stick to the 1 or 2 or 3% risk of capital, and just sort of like keep it very minimal, keep it very organized, and I'm sure it will be a lot easier for it to show to your friends and families and potential investors in the future when they take an interest. Say that in a couple of years' time, we all start becoming very, very profitable and good, and people start getting interested, and they all of a sudden are interested in giving some money to you to become their potential investor in order to grow their capital for them. And if you have something like this that shows exactly the level of detail that you go into, because you take this seriously and you treat it as a business, they will be much more inclined to see you as a professional rather than just someone who does it on a weekend in their spare time. So take it seriously. It's very, very simple to do anyway. You don't have to do it with this difficult sort of spreadsheet. It can be done on Word, on Notion, on Evernote, on Google Sheets, anything like that. But just have a log and journal it because it's very, very important and will help you in the future. Right, thank you very much for listening and watching. Hope you've taken some value, and until the next one. Cheers.